Hello, everybody. So we know that most CEOs typically will give a 3-month guidance. Sometimes they'll give a 12-month outlook. And I think Wall Street in general focuses on growth over the next 12 months and, trying to predict that growth. And in fact, that's the topic of my spreadsheet that I published on Friday is the most undervalued growth stocks. That's 12 months out. But either 3 months or 12 months, or sometimes even no guidance, that's short-term guidance. And that's very unfortunate because what really matters to us long-term investors is long-term guidance. The uncertainty of a business going up and down through peaks and troughs over the years is not as relevant as the terminal value, right? What are the sales going to be in 2030? And I invest in hyper-growth stocks. So what I mean by that is that by the time a stock trades on the basis of PE ratio, right, that doesn't matter anymore to me because by the time a stock for me trades at a reasonable PE, that means that the growth phase is entirely gone. So even though some analysts or some people focus on earnings growth, I understand that earnings growth is helpful to a lot of people, but to me, I really want to get it early in stocks, early at the hyper-growth stage. So I've been showing this chart over the past few videos, which kind of captures my philosophy is I want to get in when a stock shows a lot of sales, in the beginning and a lot of growth, and those sales grow maybe over a 10-year period. And at the early signs of growth slowdown is when I want to exit the stock. I never really want to get into a stage where, for example, a stock grows earnings, but most of that earnings growth is based on, say, share buybacks or things like that, right? A typical example of that would be Apple, right? Apple is showing earnings growth, but that's a lot of share buyback that's behind that, not actual organic growth as seen through the lens of sales. And sales don't lie. Sales are a direct proxy of product adoption. The company's product is getting adopted when there are sales. So in this video, what I want to do is I want to go over 5 stocks and 5 CEOs who are bold enough and who were bold enough and kind enough to give us 3 years guidance and sometimes 10-year guidance, as we'll see for a company like Tesla or Palantir. So this is awesome. This is really awesome for me to have long-term guidance. It gives me much more confidence to invest in a stock when I know what the CEO is thinking in the very long term. It gives me a lot of insight into what they're thinking the total addressable market is. And with this insight, that removes uncertainty and that makes you much more okay to go through peaks and troughs in the stock price, because stock price in the short term doesn't really matter. What matters is the growth in revenue, in my view, at least for the style of investing that I do. So let me get started and start with the first stock in this video that has given long-term guidance, and that stock is Hims and Hers, right? So the preventive ape, it's a preventive healthcare company outside of the insurance system that treats a lot of minor issues that people usually don't get treated. So they have a lot of induced demand from their product offering, right? Revenue for Hims, they are predicting $1.2 billion by the end of 2025. So this would be the guidance, 22, 23, 24, 25 is kind of my estimate of where it's going to be, and this is their number, the guided number, 1.5 million at the end of 2025. So that would mean that in February 26, so about 3 years from now, if we keep the same depressed price to sell, the same depressed valuation, we could expect the stock to be at a $5.7 billion market cap. Today's market cap is about $2 billion. That's a 2.82 times your money in 3 years. At least that's what I'm expecting for my investment in Hims, which would be a 39% average annual return, which is above my 30% threshold of what I look for. So Hims to me is a green check mark. I love to have the guidance. It makes me much more confidence buying the stock with that guidance and with what we can expect by the end of 2025. Moving on to the next stock here is Palantir. So I've been back and forth on Palantir, but at least of my opinions of the stock, but I think the CEO has done an outstanding job growing Palantir over the past 10 years, when you really think about it. And this company was, really a 0 to 1 company, started from scratch. Anyways, I don't want to get into the software for this video. If you've seen all of my videos on Palantir, you know that I like Palantir a lot because of the military business and the margin safety that it gets. The software, they still believe it will get adopted. And what Alex Karp has been saying multiple times is that over the long run, right? Over this current decade, revenue growth, sales growth will be about 30%. So I put it all in a spreadsheet. So assuming that the growth is about 30% a year from the latest number that we had, so end of year 2022, we had 1.91 billion in sales. Assuming that 30% growth, end of 2029 would give us a $12 billion roughly in sales. First, I assume some price to sales compression. Assuming that price to sales compression, about 5% compression each year is what I'm assuming here. We would get to a market cap of 17 billion today to 75 billion by the end of 2029, right? And that would be a 4.4 times in 6.9 months. In 6 years and 9 months. 6 years and 9 months, 4.4 time. If you do it in a rate of return, right, annualized rate of return, you would get 24.4%, which is excellent. But not quite as high as what I seek, right? I seek about 30%, but that's still pretty good. I mean, nothing to sneeze at. Now, I think, and this is perhaps more likely in my view, because the value of Palantir is very depressed right now, given the margin of this company, given the positioning, right? The U.S. military, they are that software supplier of the U.S. military. So given their positioning and their margin, I believe going down to a 6 price to sell is a little low. Assuming the same price to sales today in 2029 of 9, that'd be a market cap of $107 billion. And of course, that would be a 6.3 times then in 6 years and 9 months, which would lead to an average rate of return each year of 31.2%. So that is above my threshold. That is very good in my view. I am happy to own Palantir. And by the way, all of the stocks in this video I owned except Snowflake. I exited Snowflake, and I'll show you in the last video why they don't have as much as well of the numbers because of their valuation today. Okay, moving on to stock number 3, which is my number 1 position. It's almost unreasonable sometimes, the size of that position in my portfolio, but that's okay. The number 1 position, and I think to a lot of hyper-growth investors, is Tesla. You know, when you look at Tesla, you have to wonder, how could a company this big, how could a company with a 590 billion market cap keep growing this fast? I don't think that has happened in the history of business. No, companies this big don't grow this fast. It just doesn't happen that way. Except for Tesla, it's happening. And you know that a lot. I mean, you still have most of Wall Street who doesn't understand, doesn't get Tesla. Most people don't get Tesla. In fact, I was one of those people who didn't get Tesla. I got Tesla fairly late, I would argue, compared to a lot of the YouTube crowd. But anyways, what has Elon Musk guided? So he kept saying, and he's kept saying that so many times, it's going to be 20 million vehicles in 2030. So by 2030, we're going to do 20 million vehicles. He's been pounding the table on that objective for well over 2 years. It's noteworthy to say that I think it was in 2017, Elon Musk had guided something crazy for 2021, and they achieved it, right? He had guided something like a $500 billion market cap, and he's already achieved it. So this is a CEO that has already guided something seemingly crazy and has achieved it. And so the guidance here I take seriously because he's already done it. This company should have never been to the level of that it's at. And I don't necessarily mean market cap, right? I mean in the number of sales. They have $80 billion in sales worth of cars. That should not have happened. And so when I look at the numbers, you know, what do you see? You see Tesla 2022 deliveries is 1.3 million, and then increasing those deliveries by 50% a year, assuming that, right, you would get to 22.2 million. So even that is possible, right? 20 million by 2029 is possible, because if you grow 50% compounded for all of these years, you're going to get at 22 million. Now, Tesla says 20 million, right? Even though they keep routinely saying more than 50%, below 50%, depending on the year, they're reaching 20 million. So they're assuming some compression of the growth, and it's normal. You know, it's the law of large numbers. But let's keep in mind that 20 million vehicles would be about 25% of all of the cars sold in the world. There's about 80 million cars sold each year in the world. So that'd be about 25%. And so the question is it possible to imagine a car brand that has 25% of the market? with my knowledge of technology, I don't have any issues imagining that. I don't have any issues because I see what happened to the smartphone market, and I see that Apple is what roughly. I mean, in rich countries, Apple is roughly 50%. That's just the way it is. So I don't have any issue imagining that at all. Going to the numbers, right? And we have to use the numbers. So the current market cap is 590, and assuming a sale price of 50,000 in 2030, and you may say, oh, that seems high. They've been talking about reducing the price. Well, there's a few things that I want to say. Yes, they're gonna have a Model 2, which is gonna be cheaper, and Model 3, Model Y. They're going to be slightly cheaper than 50K, but there's two things that people forget. Is first of all, they're going to have the Cybertruck and the Semi, which are both going to be in the 100, let's say 100 for Cybertruck, maybe 200 plus, likely 200 plus for the Semi range. So that's going to increase the average sales price. And another important thing when you look at the 50,000 sales price is you have to predict by 2030 what's going to be the self-driving software take rate. What's going to be that take rate at the end of a decade. Right now it's very low, but part of the big bet of Tesla is that by 2026, 2027, maybe it's not like full self-driving, but maybe they're like 99% there, and at that point that becomes extremely compelling to get it at that point, right? And you also have some inflation, even though if you know me, I believe technology is going to be deflationary mostly, but you still have some inflation that may make customers more accepting of high prices in 2030, even though in general I believe technology is deflationary. That's a factor. And don't forget, this doesn't include any of the side businesses of Tesla, whether it's the utility business, the Powerwall business, the Mega, the Mega Pack business. That doesn't include any of these other side business, insurance, etc. So just looking at cars. So assuming 20 million cars times 50,000 in sales, and I've kind of made the case why that's possible. And by the way, that doesn't really matter. Like, you can put 30,000, you're going to get into multiple X's really, really quickly, even if you put 30,000. But the point is, scenario one, I'm assuming a price to sales of 5. So assuming, being conservative and assuming a compression from today, a compression to a price sale of 5, assuming that would be a 8.5x from today. So in 6 years and 9 months, you would have an 8.5x, which would give you a rate of return of 37% per year on average. And that's assuming price to sales compression. Now, if you don't assume any price to sales compression, and you keep it at the same as it is today, a 7.5, then you would get a 12.7, let's run it up to 13x, almost a 13x from today, right, in 6.75 years, and that would be an internal rate of return of 46%. I'm going to run it up to 46%. So absolutely insane returns when you consider Tesla. And by the way, these numbers are not too far-fetched. Another company that sells mostly hardware, like Tesla right now, and a little bit of software is obviously Apple. And Apple has a price-to-sales ratio currently in the current market, which is somewhat depressed in my view, even for a company like Apple, has a 6.5. So the truth, probably somewhere in the middle, maybe more. I don't know. Being conservative, I think if you're a conservative investor, a 6.5, somewhere between that range. If you're a conservative investor, would be a conservative estimate of where they're going to get. And like all YouTubers who talk about Tesla, I expect some backlash in the comments, but that's okay. Like I said, it's all about having a credible commitment. It's my number one investment in my portfolio by a long shot. Like, it's really number one. So I'm saying this. I'm putting my money where my mouth is here. So just know that I have a credible commitment on this. Anyways, moving on. CrowdStrike. I love CrowdStrike. I think CrowdStrike is a great company. They got a lot of good things going for them. Definitely one of my favorite cybersecurity stocks right now. The favorite, actually. I like CrowdStrike more than Zscaler in my view. They are guiding $5 billion in annual recurring revenue by the end of 2026. So by the end of 2026, so that's about 3 years from now, right? Exactly 3 years from now. CrowdStrike just a little bit of different revenues, like a little bit of interest, a little bit of consulting. So you didn't need to adjust to just the tad of extra revenue that they have that is not recurring. And assuming that you would get from 2.2 billion today to 5.3 billion that they guided in 2026. This is guided too, by the way, the 3 billion. This is the only thing that's not guided, and that's my halfway point between end of 2026 and end of 2024 that's been guided. My halfway point is $4.1 billion here. So assuming these numbers, and assuming that CrowdStrike stays at a 14 price to sales. Now, one of the reasons why I think it's likely that it could stay there is A, it's very depressed. B, these numbers are going to be still pretty low 3 years from now compared to the total addressable market. And by depressed, I mean the market is really depressed. And 3, this is recurring revenue. So annual recurring revenue in the market tends to trade at a premium because it's a premium revenue. It's not like you're selling a car and every 7 years you have to fight for that sale. When you have recurring revenue, you don't have to fight for your sale. The customers are very sticky, and sticky revenue trades at a higher valuation because it makes the business more certain. It removes a lot of uncertainty for the business. So that's just something to keep in mind. So anyways, assuming that 14 price to sales, that'd be a 74 billion price to sales. Today's market cap is 29 billion. So that would be a 2.55x in 3 years, or 31.6% annual rate of return over 3 years, so per year 31%, above my threshold. Again, very good. Happy to own CrowdStrike in my view. And the last stock, which I recently sold on deceleration concerns and valuation concerns, I may get back in, but I'm out of this stock now. But nonetheless, that was a stock that I used to really like, a year ago when I was buying it a little heavier. And it's Snowflake. So Snowflake, has guided over and over again, will do $10 billion in revenue by March 2029. That's their year end, right? They said year end 2030, so that would be for them March 2029, because they are a forward fiscal year basis. Anyways, so that's exactly, and that's 2028, by the way, not 2030. 2028 is when they guided that. So that would be exactly 6 years from now. And in 6 years from now, exactly. So you have to ask yourself, what would the price to sales ratio be for Snowflake? I think a good proxy for what that price to sales ratio should be back in the future in 2029 is ServiceNow. Frank Slootman led ServiceNow until he moved to Snowflake, and ServiceNow is trading at 12.5 times sales. So assuming $10 billion in March of 2029, at 12.5 times sales and trailing 12 month 10 billion, right? March 2029, 12.5 times sales. That would lead to a market cap of $125 billion versus $51 billion today. And that would be a 2.5x times my money in 6 years, which is not very good. It's a 16.5% yearly return. And by the way, even if we are optimists and we assume that the crazy high valuation that Snowflake has, in my view, we go back to it, right? We go to 20x times sales, assuming that you would get a 25.5% return. So to me, still a very expensive stocks, a very expensive value proposition. The guidance and the slowdown in the growth, in my view, for Snowflake, at least for me, for now, has busted this thesis for me. But that's okay. If the stock re-rates, if the value of the stock re-rates, I will get back in because I still love the business. I still think it's a great business. But right now, people are just not spending on the data cloud. It's just not as much of a priority right now as say cybersecurity is a priority, or as say buying military software is a priority for the US government contracting with Palantir. At least that is my point of view. I hope you liked the video on these 5 hypergrowth stocks. While I think of it, please, if you have stocks in your coverage universes that you have very long-term guidance for, please let me know those stocks that have given long-term guidance. Not that many stocks give it. So if you know of more stocks that have with CEOs that have been very outspoken with their public goals, let me know, because I want to know about these stocks, and like I said, they're harder to find. So anyways, moving on, I'm done. This is not investment advice. This is just entertainment. Thank you so much for watching. Please like and subscribe. I appreciate the support. I just crossed 1,200 subscribers, so I'm very happy. Thank you, and have a wonderful day.